Thank you, Mr. Chairman. Mr. Chairman, are you familiar with the term debt saturation?
No, but I can guess what it means.
Yeah. Well, there's a formula of basically you dividing the GDP by the change in debt. And if you look back at, according to U.S. Treasury Z1 flow, it said back in 1960, a dollar in debt basically equated to a dollar in increase in productivity or GDP in this country. As from 1960 until the present, this economy, both at every level, both government, individuals, and companies have been leveraging themselves. And so where we are today is that we're to the point where we reached debt saturation, and basically for every new dollar in debt, there is, in some cases, a negative increase in GDP. That results because a lot of companies, even though they would like to borrow money, they don't have the capacity to borrow because new borrowing creates new debt service, and many of them don't have the income necessary to service that debt. In fact, if you look at the United States of America, for example, our revenues are a little over $2 trillion, and our debt service is increasing to, I think, about $500 billion and headed up. And so when you look at our monetary policy and our fiscal policy in this country right now, it's all about borrowing and spending. And we're wondering why this isn't working. And well, one of the reasons that it's not working is because, quite honestly, there's not capacity for a lot of folks to take on new debt. And when you look at a lot of companies that I talk to, they're building up cash on their balance sheets. When you look at the quantitative easing that you've done, that money really didn't go out into the economy. A lot of those folks are holding those monies in reserves in your bank. And so I guess the question I have is, you're beginning to see families and businesses deleverage because they understand that they reached that debt saturation point. Yet the Fed and the United States government has not gotten that message. I mean, so when you say that you think quantitative easing is working and you point to unemployment, I think I was a little puzzled by that last unemployment number going from 9.4 to 9. But when you look at what I think is the real unemployment number in this country, which is U6, that number actually went up. And so if the money is not going out, why would we continue a policy of the Fed borrowing more money and trying to put more money in the system when the system seems to be pretty leveraged up, and I don't see the benefits from that?
Well, Congressman, you're right that the economy got over-leveraged during the crisis. Households borrow too much. Some firms borrow too much. And one of the reasons that the recovery is slow is that this deleveraging process is going on. People are building up their savings, their wealth again. Firms are trying to reduce their debt, and in some cases their investment for that same reason. So that is part of the process. With respect to the Federal Reserve, what the Fed is doing is first of all, we're buying securities in the open market, which we will subsequently sell back into the market. We're not making any permanent change in our balance sheet. And in particular, the effect of this is not felt, in my view, is not felt primarily through the reserves in the banking sector. If it's felt by, as we buy securities in the open market, we both lower term premiums in the open market and we push investors into other kinds of investments like the stock market or corporate bonds and the like, and the improved flow of money into those securities has indeed, and the results do show that bond yields have lowered relative to treasuries, stock market is up, and those things do affect people's behavior and have helped contribute to a growing economy. It's not the same thing as what the Fed is doing is not the same thing as government spending. We are buying securities, which are assets, which pay interest, and then when the appropriate time, we will sell those back into the marketplace and return to our previous balance sheet.
Well, I would disagree a little bit with you on that because the monetary policy you have right now is to keep interest rates. Well, you've got them basically at zero. I don't guess you can take them any lower than that. If you can, I might want to borrow some money where they pay you to borrow money, but we're nearly to that point. So we're really trying to encourage people to borrow because we've got interest rates at a very low rate. And what I think I'm saying is it isn't working. And that's the reason that the economy, you know, even in your own testimony, you said we're not quite sure if we can attribute the things we're doing to the little bump in the economy here. I would submit to you what's really going on in the economy, and the bump that we're getting is the fact that some portions of our economy do understand what was going on. They're taking actions to correct their balance sheets. Families are lowering their credit card debt. But that the policies that we have, both at the Fed and this Congress, of borrowing and spending, don't work, and in fact are going to have a negative impact. That the more we borrow now from this point forward in this economy, I believe particularly at the government level, it begins to diminish our GDP and not increase our GDP. So I thank the chairman for his comments.